I think we're getting
Great.
some people coming on.
Hey, everyone. Sorry for the delay there. You have John Patton and Roger Conrad here with Conrad's Utility Investor. Thanks for joining us this evening. So we're just going to wait a few seconds and let everybody kind of settle in here, and then we'll kick things off for tonight's webinar. Okay, great. So good evening, everyone. Thanks for joining us during your dinner hour and tuning in to hear more about tonight's presentation from Roger Conrad and in preparation for the Edison Electric Institute conference, which Roger will be attending soon. I want to introduce myself. My name is John Patton, and I'm the Marketing Director of Capitalist Times, which is the publisher of Conrad's Utility Investor. And tonight we're presenting Roger Conrad, who is the founder, editor, and chief analyst of Conrad's Utility Investor, which is actually now in its 5th year of publication. And so I know I'm a new face, but I'm really excited to meet all of you online here and talk a little bit about Roger and introduce him tonight. So Roger, as you all know, has made a living providing investment advice on utilities, telecoms, other essential services for over 30 years. His published advisories have regularly earned high marks from independent rating services, including the Holbert Financial Digest, and more importantly, from his subscribers. His book, Power Hungry Strategic Investing in Utilities, Telecoms, and Other Essential Services, published in 2002, continues to be used as an industry resource. And for the past 5 years, I've had the privilege to work with Roger, and he has been an independent trustee of Miller Howard Investments Mutual Funds and reelected this year by shareholders for another term. The topic tonight in Roger's discussion is really going to center around the Edison Electric Institute's 52nd annual financial conference. This is a 4-day series of meetings where money managers, analysts, and qualified investors attend formal and informal meetings with leading industry CEOs, CFOs, and other executives. And Roger's post-conference picks from each of the past years have actually beaten the S&P 500 and the S&P utility sector averages by better than 2 to 1, with around a 30% gain. Actually, a better than 30% gain. I don't want to undersell Roger. And his pans have actually kept Conrad's utility readers from hitting a lot of underperformers or keeping those in their portfolios and other outright losses. So let's back up a little bit and just talk a little about the conference here. This year's conference, Roger, it starts on Sunday, November 5th. Is that right?
Yeah, absolutely. And runs through the following Wednesday, November 9th.
Yeah, great.
November 8th, actually.
Yeah, and so what we're really excited about is prepping everyone here and kind of getting them introduced to what we're going to be looking for at EEI. And then also the follow-up strategy session that's going to happen Thursday, November 9th. And we always publish that right after the conference and get it into everyone's hands so that they can be ready to jump on these opportunities or, avoid some of the pans that you anticipate seeing at the conference. So tonight, Roger, you're going to look through kind of the current state of the utility sector and what you're going to be looking for at EEI 52 is what we're going to be calling it. That's going to be our vernacular here for tonight. And he's going to field questions afterwards, right after the presentation tonight. So all of you that are listening in tonight, start thinking of your questions and write them down now, and just in case so you don't forget. We typically get to most of the questions, but we also don't want to keep you up past midnight. So we'll be sure to answer as many as we can in a timely fashion. So again, we just want to thank you all for making the time on a Thursday evening here, skipping your favorite TV show maybe and tuning into our special program here. So thank you again, and we hope you find this event helpful. And with that, Roger, I'm going to throw it over to you.
All right, thanks, John. And I want to just start out briefly by talking about just the what we're going to be talking about here. And we call it agenda and housekeeping. First off, just like John said, the entire interview and Q&A is being recorded, and we will send you a link as soon as the recording is processed, as well as everybody else who's registered for this. So if you feel like you missed something, you can always go back and check it out again. I'm going to talk about basically two kind of big subject areas. One is opportunities, and I do think there are quite a few in the utility space right now. But I'm also going to talk about the risks, and I think one of the things that a lot of people have, I think, forgotten in this market, which is dominated by exchange-traded funds, dominated by sector-focused strategies, is that differentiation really does matter. In the past few years, we've seen differences of as much as 40, 50 percentage points between the top performing utilities and the bottom performing utilities. So differentiation has been very important. And I think as we get deeper into this bull market, and of course there are any number of prognostications about when this might end, but differentiation will become ever more important the longer this goes on, and particularly when the bull market does come to a close. So we're going to talk about opportunities, and I think there's quite a few out there in the utility space. I think, again, there's a lot of risk, and that's one of the reasons why we go to conferences with Conrad's Utility Investor. Of course, they're utility-centric conferences, and there's nothing like the Edison Electric Institute's annual meetings, which last year were in Phoenix. The year before that were in Miami, and I was at both of those. And this year they're in Orlando. And it's an opportunity where I can take what I've learned in looking at, just looking at these companies over the course of many years, looking at their strategies, looking at their numbers, because we've seen a whole lot of those come out the last few days with the third quarter, their guidance, and being able to actually sit down with the CEOs and CFOs of these companies and ask questions person to person. And it's an invaluable event. There are presentations that are made, so those are always interesting. There's themes, broad themes of conferences. Last year, it was all about utilities getting up with the tech companies and basically how big technology companies have become the most important commercial and industrial customers for utilities, and how that was shaping policy. And of course, the companies that were doing the best job of that are the ones making the most money. This year, it looks like there's going to be a lot of talk about utility rates, and particularly how to adapt utility rates to a changing marketplace. So again, very interesting topics. You really do discern a lot of things from going to these things. And so that's why I call it a must-see event for income investors. A couple of years ago, I went and I found SunPower, a big solar power components maker, was actually co-sponsoring the conference. And in fact, the CEO was a panelist. And that told me that solar power companies that had been considered to be upstarts and had been considered to be disruptors of utilities business models were actually now being partners of utilities. And of course, we've seen utilities really take off with solar energy ever since then. That wasn't a theme that many people were talking about at the time. In fact, I didn't see pretty much anyone talking about that at the time. All the commentary was about how solar power companies were going to take sales away from utilities at the time. But solar has been a big profit mover for utilities, and in the last couple of years. And again, this is the kinds of things that you get at these conferences that you just don't get if you're sitting in front of your computer, or even no matter how many conference calls you participate in. So this is what I'm going to talk about. We're going to conclude with questions and answers, and hopefully you'll have quite a few going from the presentation, or possibly about utilities in general, but I'll be very happy to take them. That's a part of my job I really do enjoy.
And Roger, one point before we jump in here, and thanks for that intro there. Folks, if you have questions, feel free to ping us while we're going through the presentation, and we'll see those presented to us as we kind of go through this. And
absolutely, yeah. I mean, and I don't mind interrupting my remarks either. If you, John, if you see a question that you think needs to be addressed. I just want to go to the next slide here, and just talking briefly about utility risks and rewards and the importance of differentiation in this sector. I do think that we are seeing a real boom in the sector right now. It's definitely the healthiest that I've ever seen it in 30 years of covering it, which goes back to mid-1980s. In fact, I think you really have to go back to the early 1960s to see this industry in the pink of health it's in today. You know, dividend growth rates are the fastest that we've seen in decades. In fact, there's a fairly sizable, what I call a 10% club, where you see utilities actually growing dividends at 10% a year. It's something that's been pretty much unheard of in the recent past. Something you had to go back into the 60s when these things were trading at pretty high multiples, and when utilities were actually building out the power grid around the country. So we're at the fastest dividend growth in decades. Balance sheets are very strong. I think, in fact, they're undervalued at this point. Credit raters tend to look back at the last crisis, which in this case was about 15 years ago with Enron's collapse. But since then, we've seen companies really get their acts together, cut debt, cut operating risk, focus on the core business. And the result is a very low cost of capital we're seeing now. Companies able to borrow money 40, 50 years out by issuing bonds with yields of in the 4 or 5% range. So that's very, very low cost money. Of course, the stocks are up a lot too. So that's very good for a capital intensive business that's investing in growth. And of course, the opportunities are immense in this industry right now. IoT is the Internet of Things. Primarily think about it in terms of telecoms and data and so forth. And we do cover telecoms in Conrad's Utility Investor. It's a very big focus area. But in terms of utilities and in terms of Edison Electric, this is an area where companies can really cut costs. In fact, it's phenomenal, some of the savings that people are talking about, as much as $1.5 trillion in potential savings over the next 10 years in this industry. Now, how's that possible? Well, primarily because the Internet of Things is machines talking to each other, synthesizing really large amounts of data and using it to improve operations. In the case of a power plant, typical power plant right now, utilities take away about 2% of the data generated from that power plant. Internet of Things has the capability to increase that manifold, and by doing that, basically allowing utilities to do preventive maintenance. So instead of having to shut a plant down to do maintenance something wears out, or worse, having a plant shut down and having to replace a part, they'll actually be able to predict the optimal time to replace various parts, and be able also to show like what parts are wearing down at what time, so they can react to possibly avoid making that repair altogether. So it's really kind of mind-boggling that the opportunity involved here, and utilities have a tremendous opportunity to adopt these new technologies, cut their costs, cut customer rates, and that's definitely a subject area I'm going to be exploring at EEI. EVs, electric vehicles, that's something that a lot of people have talked about. Certainly a lot of excitement about some of the stocks out there like Tesla. My thesis, though, is that utilities are probably going to be the major beneficiaries, or if not that, in any case, the surest beneficiaries as they build infrastructure. And again, this is an area that I think a lot of companies are going to be talking about at the conference. Renewables, of course, this is a multi-year trend, and I think one of the big surprises of the early Trump administration has been the fact that actually utility adoption of renewables has accelerated. It's purely an economic decision, and I think shows that, again, how a lot of the technology is really become a driving force in the sector. But obviously, how utilities are going to spend their money and how much of that is going to involve wind and solar and other renewable energy sources, as well as grid investment, that's going to be a really big deal for what we see at this conference. Water is an area that we've actually now seen some electric companies get involved in. A company called EverSource, which is actually going to be there at EEI, and I intend to talk to them a bit about their water strategy, which is right now involves buying a company called Aquarian, which is based in New England and contiguous to EverSource's service territory there. So this is an interesting area because for many angles. One, because water stocks are probably the most expensive utilities out there right now. But two, from utilities' point of view, what sort of synergies can they get from acquiring these types of properties? So again, something very interesting that I'll be looking for insights at EEI. And of course, mergers are always a big topic at these events, and there are several companies that are actually going into mergers right now, and or in the process. Now, of course, they're not going to share their innermost, darkest secrets, but last year, actually, I was able to, by talking to first the representative of one company that was merging, and then talking to another representative of the other company they were merging with, was able to find some highlights, pinpoint some contradictions in what they were saying. And it was a warning sign that this deal wasn't necessarily ready to sail through. And in fact, this merger actually did fail. So again, another thing that another benefit of going to EEI, and that's something that, again, you're not going to find in a press release or even at listening to conference calls and so forth. I've talked about regulatory relations being strong for a long time. That's been a cornerstone of the utility surge since over the last 15 years or so. But there are always signs of fraying, and of course there are a couple of companies right now that are in some pretty hot water with their officials. Again, these are developments that we want to explore at this conference. But there are also a couple of states that are on the verge of some very favorable developments, and those are questions I'm going to be asking there as well. Share prices will track growth rates, and again, that's kind of a bottom line underscoring things. How are companies making their guidance? The last issue of Conrad's Utility Investor, I looked at how companies' own guidance, how companies' own projections of their growth compare with how Wall Street projects those growth rates to be. And there are a number of companies, surprisingly, that are projecting much faster growth than Wall Street's believing. So if you can find those types of situations where companies are actually able to execute on their guidance plans, then Wall Street eventually comes around and you're going to see that stock at a much higher multiple. It's going to be a big winner. So again, these are the types of things I'm looking for to find the next group of winners. I've actually been had pretty good fortune the last couple of years finding winners, and I expect to find more winners this year, even though we are further along in this bull market, and even though, as the other side of the screen here indicates, there are some considerable risks in this sector. And again, risks are another thing that you can discern much more easily kind of on the ground talking to people. That's what EEI is all about. What are some of the risks that I see out there? Well, the valuations are pretty high for this group. The big cap utility yields are at their lowest levels in decades. That's kind of the reverse of having a very low cost of capital, is that you don't get a really big yield when you buy a company's stocks and bonds. And valuations are, in fact, as that next point makes, higher than at the two most recent market peaks, which would be in early 2008 for utilities, also in early 2001. And those are some pretty substantial falls that occurred after that. I'm not predicting anything of that nature, but I think what it does show you is high valuations mean high expectations, and those are more easily shattered than low expectations when you have a high bar to overcome. So a couple of things to worry about there. And it is possible that I'll take a look at some of these companies that are at this conference, and in conjunction with their earnings, in conjunction with their guidance, I'll make a decision that, hey, I'm undervaluing this thing. It really does deserve a higher valuation. So that's possible. And I've got a couple of companies on my target list that I'm going to be looking for clues if that's the case. But I'm also going to be looking for clues that companies are going to disappoint Wall Street. And I think, again, at this point, I think there's more odds of that happening with particularly some of the more popular names out there that a lot of people own. So those are the kind of warning signs I'll be looking for and hoping to pass along to Conrad's Utility Investor readers in the special report I'll be doing after this EEI conference. Federal regulation is perceived as positive, but is increasingly at odds with states. The irony is that in a lot of the states, things are also very positive. So how the federal government is going to war with the states in energy, and this is something I think we could well see in some parts of the country. Utility is going to be caught in between. This was a problem companies had last year in some of the areas of the country when the Obama administration's been pushing the Clean Power Plan under the Environmental Protection Agency, and so they had to line up their business plans with that as a possibility in mind, even though the states that they operated in maybe didn't want to go along that way. So the utilities were in the way there, right in between. Well, now things have kind of reversed up a little bit, and you have a lot of companies in states that are really pushing for more use of renewable energy, but the federal government wants to see greater use of coal or at least shutting down or preventing some of the shutdowns of nuclear and coal plants that we've been seeing. So again, these are the kinds of things that kind of nuances I'll be looking at EEI for risks of companies. I think the biggest thing that I've been worried about in the utility space and in also the overall market space has been the rise of passive investing. This is a concept, you can, a lot of you are familiar with, but it's basically the amounts, what we're talking about is money that goes into various plans, various target plans that big brokerages, big houses have, places like Vanguard and so forth. And they put you into, the strategies are basically put you into a group of ETFs, and they allocate your asset or exchange traded funds, and they allocate your assets between those based on the risk preference you put down, your time to retirement, and so on. And the idea is that you basically can just sit and forget, and computer generated algorithms will manage the funds depending on market conditions and so on. This is a very, very popular form of investing. The problem is nobody really knows what's going to happen when markets start coming down. What are these algorithms going to do? We do know that a lot of these algorithms are written very similarly. So they're probably going to do the same thing across the board, which may be good, may not be so good. Certainly the last time we had something of this nature that really permeated the markets, it was the mortgage crisis we had about 10 years ago. So it's something to worry about. What worries me about the utilities is a lot of these companies are becoming very heavily owned by passive investing, in passive investing strategies. I've done some work on that. This actually in the September issue of Conrad's Utility Investor that's posted on the site. And what we're seeing right now is, again, this passive investing really taking off, companies being 25, 30, even in some cases 35, 40% owned by these passive strategies. And at the same time, their valuations are now at levels that are well beyond what they were at the last two market peaks. So again, a risk that I'm looking for, I think something that makes me want to really redouble my efforts in terms of making sure that I'm in the right stocks. And again, EEI is the place to go and really take a look at things in graphic detail. So this kind of describes my view of the utility industry and what I'm looking for. And I just wanted to go in a little bit deeper into one of the subject areas, and that is what my next slide is here, solar energy. And I mentioned that renewable power is very much a growth area for utilities, and I mentioned that a couple of years ago.
Wait, so Roger, are you saying what I think you're saying here? You're saying that solar power is now competitive with other energy sources like coal?
Yeah, it's pretty clear. I mean, if you look at this graph here, you can see that it's only just now happened for some of these fuel sources. Utility scale PV, which is basically very large solar facilities that are plugged into the grid. Often they're owned by third parties, and utilities buy the power under long-term contracts. Utilities are, though, investing in these things themselves. So, but these have actually become, in many parts of the country, cheaper than running existing coal plants. So, pretty phenomenal developments here. We've actually seen as the next slide we'll look at. We've actually seen regarding wind power. We've actually seen wind power get cheaper than natural gas in the state of Texas. So we've seen a large amount of capacity, natural gas-fired capacity in Texas actually shut down as windmills have come on stream. So, again, this is something that is not really conventional wisdom, other than from cheerleaders of renewable energy, who I think are, in many cases, kind of unreliable sources of information or of opinion. But this is happening. You are seeing these costs come down, and they're coming down at the same time that these coal plants, 50 years old, 40, 50 years old, are wearing out. So it's basically a tremendous turnover of utility plant, if you will, as older facilities are shut down and they're being replaced by natural gas. And natural gas is a really big part of the sector. There are a number of companies that are invested heavily in gas, one of which is Dominion Resources, that is will be there at EEI, and I'm very interested in its gas plans. But Dominion also has stuff going on in offshore wind off the coast of Virginia.
So, Roger, does that mean that you're taking a different position than what we're hearing from the Trump administration? And like a lot of our readers, I've been reading that solar development isn't necessarily a good thing for utilities. It seems like the conventional wisdom is that solar adoption has the potential to put utilities in a death spiral, where they lose sales and are forced to raise rates on their customers, which then leads to more defections and lost sales. And there's also the 35% tariffs proposed this week, actually, on imported solar components by the U.S. International Trade Commission. Won't this slow solar deployment and hurt the investment trends you've just described?
Yeah, it's a really good question. I mean, first off, I do think that what the administration is trying to do is basically at odds with what utilities have been doing, and what I've been seeing over the past year or so, as companies have been, even in regulated markets like Florida, we've seen coal power plants shut down well ahead of where they would ordinarily or what initially they were anticipated to run to, on the basis that shutting them down and replacing them with something like solar would actually cut costs for the utility. That was NextEra Energy, or the parent company of Florida Power and Light. And we're also seeing coal-fired plants shut down in unregulated markets like Texas, even as and again, this was a big part of the October issue of Conrad's Utility Investor, talking about the new Trump administration policies and kind of looking at what's been happening, how industry has been responding. And this is going to be a huge thing at EEI, I think. Are companies sticking to the strategies that they had? Are there ways that they can change the strategies that they have and take advantage of some of this, some of these new policies? Like, for example, the tariff on solar power, probably going to be fairly damaging to rooftop installations around the country. So those are the competitors of utilities, companies that have been building. And
looks like Roger, we lost you for a little bit there. Looks like you're back in.
Oh, well, I'm sorry about that. And
just the last 10 seconds or so, Roger.
Yeah. No, well, just to run that back, and I won't belabor it, but this is an area where I'll definitely be looking very closely at the Edison Electric Institute meetings. How are companies sticking with the plans that they laid out last year, and these long-term plans? Where are they changing them to adapt to some of these changes? I think actually these solar tariffs are going to come out to be reasonably favorable for utilities. This was a point I made in the October issue of Conrad's Utility Investor. I think they'll be positive in the sense that residential solar becomes a lot less competitive. Utilities, though, have the ability to continue to follow through on the solar plants they built. And if solar panels become too expensive with tariffs, they can shift to wind. So there's a lot, or natural gas. So there's a lot of investment opportunities for companies to make. I don't want to make to give the impression that I don't think that the Trump policies will have some effect. And the next couple of slides, I think, will make that point. The first one is basically shows these states around the country. And if you look at the dark blue ones, you can see states that have actually accelerated their renewable energy targets since the Trump administration took office. And in many cases, as a reaction to the withdrawal from the Paris Accord. So you've seen a tremendous amount of state and local activism that's really stepped up these targets. Now, are these targets attainable? I don't think anybody knows, but one thing they do very effectively is push utilities in a direction where they're going to deploy more of these types of resources. So, and it also means regulators in these states are going to support the utility spending plans. And that's really the most important thing for any utility. You want the state to support where you're spending your money so you can roll that into higher dividends, higher earnings, and so on and so forth. So you can see a number of states have actually increased their standards. The city of St. Louis actually has announced a 100% renewable energy goal. I don't know if they can achieve that. I don't know if that's possible to achieve that in the next 20 years or so. Timetable's pretty aggressive, but again, that shows you that at least on the state level, the incentive for utilities to make this investment and the assurance that they're going to get a fair rate of return on that investment is pretty strong. But again, these are the types of things that you can really pick up nuances on in these meetings, and you can look at how utilities are making their capital plans, how they're responding, how they're getting along with the regulators in getting this done. Are these changes working to their advantage, or are they working against them? It's one thing that's really extraordinary about solar, just to leave it on that point, is that some of the fastest deployment right now is going on in states that don't actually have renewable portfolio standards. So states like Florida, like Georgia, like Alabama, you're seeing a lot of solar rolled out. All by the same token, a lot of wind's being rolled out in Kansas, and they actually did away with their renewable portfolio standard. So it's, again, this transition is happening, but we really want to see kind of on the ground to what extent and what changes there are from the following year. There is the next slide, though. I think there is an area where Trump administration policy is going to make a difference. And again, this is another subject area I'm very interested in pursuing at AEI because all the major players are going to be there in nuclear power. And what are their plans going forward? Of course, we've seen First Energy, just to give you a for instance, has said it wants to divest all its nuclear power plants and so forth. That's part of a long-term plan. But the Trump administration has proposed through the Department of Energy and Secretary Rick Perry that the Federal Energy Regulatory Commission order these various areas around the country to provide a subsidy for nuclear power plants as well as coal plants. So coal plants have been the ones that have gotten all the publicity, but what this has also done is it convinced a number of states to offer subsidy for nuclear power plants to keep those running. So that's super bullish for some of for a small handful of companies out there. And again, not something I hear a lot of people looking at, but it's at least enough of a big deal for me to take a look at a couple of companies that we have in the portfolio and to make a decision on, do I want to raise the buy target for these things? Is this enough of an earnings catalyst where I've thought that this has been an overvalued stock, but maybe it's not so overvalued? Again, something you have to continue to reassess in a market like this where differentiation is so important. But nuclear power could be a major beneficiary from Trump administration policies. And not only that, but also Southern Company and its attempt to construct a new nuclear power plant in Georgia, the Vogtle nuclear plant. And they've gotten quite a bit of support from the Trump administration as well in the form of new low-cost loans, greasing the skids in terms of regulation. So they're a big beneficiary. I think they're potentially a lot more. So,
so Roger, can I interrupt for a second? Because
yeah,
that's another bit of unconventional wisdom from from our readers, and they've been aware of that for some time. And for new folks, it's obvious you're going to get a much better feel for how utility management is responding to these issues by asking questions up close and personal, than is otherwise possible. But let me stop you again, because with another concern we've heard from investors, interest rates have been low for a couple of decades. And, now that the Federal Reserve is raising interest rates again, and aren't you concerned that utilities have kind of had their day? And I'm just asking this to be devil's advocate, because I know everybody's probably thinking that, who's listening in right now.
Well, fortunately, I have the next slide that you've teed me up for there. And I've tried to make the point in various ways to people over the years that interest rates, while they are an important driver, particularly for the overall stock market, and they can be a driver of profits for companies that are very capital intensive and borrow a lot of money like utilities, but they're really not the primary driver of returns for utilities. They've just never been. And I went back. I love going back and looking at old statistics and seeing what really happened in various situations. But I went back looked at what the Federal Reserve, the Fed, had done through the Fed funds rate in the post-World War II period. So it goes back a pretty long time, a lot of different scenarios, recessions, inflation, and so on. And what I found here is on this table. What it shows you is the tightening cycle, the magnitude of the tightening cycle, every tightening cycle since the first one being starting July 1954 and ending in October 1957. What happened to the Fed funds rate? So that time it went from 0.8% to 3.5%. And then we got to what happened with utilities. Well, the Dow Jones Utility Average is actually up 14.6% over that period. Not a huge return, but a positive return. And that was a pretty big in terms of magnitude of interest rate increases there. Go down the list here, you can see several times 50s, 60s, actually some pretty positive returns for utilities over that time. And then in more recent history, you can see 2004, 2006, and we could actually this graph actually, if it were updated, would show that the Fed funds rate's gone from 0 to about 1.25 and the utility average is up about 36% over that time. So it's been these times of rising interest rates have actually been times of where you can make some serious money, even in the big cap utilities, even in the average big cap utility. Of course, you could do a lot better by differentiating, but I think that's, again, something not a lot of people are aware of. Now, if you look at the negative numbers here, all these coincided with big declines in the stock market, and the biggest one being the big bear market of 71, 74, certainly a very tough time to own stocks, a lot of the oil shocks, inflation, Nixon resigning, and so forth. And the Fed funds rate really jacked up over that time. And, that was a bad time to own stocks across the board. So I guess the big point here is that utilities are really no different than any other stocks. Most of their return, or a good chunk of their return, is going to come from dividends, or at least a higher chunk of their returns than the average stock is going to come from dividends. But at the end of the day, total returns do mirror those of the overall stock market. And I've made this point, again, a lot of times in Conrad's Utility Investor to readers as a preface for why a particular sell-off that certainly when a lot of people were worried about interest rates and these stocks had gotten a little bit weaker in the near term, why that was a good buying opportunity. And we have had some really good buying opportunities over the past 5 years. And what I mean by that are just the opportunities to go out and buy best-in-class companies at very low prices by coming in there at the time when people are the most worried. And, I think that's, and interest rates certainly do command attention of people in dividend-paying stocks. And you do get those opportunities to get in there. But I do think that there are some much more serious risks out there than this. I mean, interest rates are going to have an impact on growth if you increase them at a fast enough pace. Interest rates will have an impact on the stock market if you do that as well. But really, when you look at what's really been the driver for stocks across the board, utilities, it's been the economy. And utilities, like everybody else, make more money when times are good. They don't tend to lose as much when times are bad. They tend to be very steady, because that's the last thing you're going to turn off is probably your electricity or your gas or so forth. And I even extend that to water and telecoms, like as I do cover in the letter. But that's really the bottom line. I mean, they're going to do better, and the market's going to do better. And that's why utilities had a horrible year in 2008, which was the year when interest rates just came down through the floor. And they had a good year in 2009 when interest rates really picked up steam. So again, interest rates are not so critical. I mean, I do look very closely at borrowing costs. I think that's important, obviously, because you have a capital-intensive industry. But again, not as critical as people think. I think what is critical is what's on the next slide here, and that is very high valuations. And I alluded to that earlier in the briefing, that utilities right now are at some of their highest valuations that we've seen in many years. This graph here just goes back to immediately before the last big crash in the market, which was 2008. And as you can see, we're right back at those levels again. I think again, it's been a good time to own utilities. It's been a good time for utilities making money. The earnings have certainly responded. Dividend growth has certainly responded. So you could make a case that they deserve higher valuations, and some honestly do. But I'd also think that when you do get these higher valuations, you get a lot more potential for disappointment. And when stocks are disappointed from high levels, they tend to come down in a very big way. And the next slide is pretty much shows you what happens here. This is 4 companies and the graph goes back to roughly about the time when, or the beginning of this year, call it that. And this is a comparison graph courtesy of Bloomberg that allows you to see what the rolling total return is for stocks, indexes, and the like. What I've done here is I've graphed 3 utility companies and the underlying index for the XLU, which is the leading utility exchange traded fund, which maybe some of you own. The graph, the red line there is one of the top performers in the utility group. It's a company called Algonquin Power and Utilities. It was actually one of my picks coming out of the last conference. So that's a big reason for the outperformance that we had. What it had going into this year was it was on the verge of a major merger with U.S. utility that was going to cause it to list on the New York Stock Exchange. So it went from being a fairly obscure but very solid utility that had renewable energy assets to being a major player listed on the New York Stock Exchange. And as people became aware of it, that good performance that it has a company became more attended to, and its valuation went up. So that was a pretty good example of being opportunistic in a name that not a lot of people are aware of. And of course, there's a lot more going on with that company that I'm going to be exploring at this year's EEI. It may be back on my list again. It just made the acquisition of a major solar power. Yieldco just announced that this week. So I'm going to be asking about that. And this may be, again, one of my top picks again. But it certainly was that year by the power of differentiation, by being out of the public eye and not having high expectations, I guess is the underlying, not having high expectations built into its share price, which I guess is the underlying point here. It was a good year for the average utility, as that orange line indicates, you did make money if you held that ETF, again, a lot of that's, I think, passive money coming into things like that, but it was a good year to own utilities. That wasn't a given coming out of that investment conference. We just had an election, and of course, the perception was that utilities would be performing much worse in the under a Trump administration than they had under the Obama administration. Kind of turned things on its ear because traditionally Republicans have been at least as good for utility stocks. But I think it's pretty good reason for I think the lesson coming out of that was keep politics out of investing, aside from things that are actually affecting individual companies. And being at EEI was invaluable for me, just looking at what companies were doing and how they were responding to the environment. So that's one reason why I was actually bullish on utilities coming out of that conference, even though I was a little bit worried about valuations. You can actually look at the last report we had, or the last year's report. It is on the Conrad's Utility Investor website, as is the from the year before, the conference report that I went to the year before. Anyway, good year for overall utilities. But the other 2 lines on this graph, not so good. These are PG&E, that's the white line, and then a company called SCANA, which is the yellow line. Both these companies started the year very high valuations. SCANA was a takeover target, frequently cited. And you can see PG&E kind of moved along with the average and recently has plunged. That is the result of deep concern about whether it's liable for damage from fires in the wine country that over the past month or so. A lot of concern there that the company will face a huge amount of damages. But what's really happened so far to that stock is it's just gone from a high valuation, a really high, super high valuation, one of the highest it's ever had, down to one that's more normal. So that one could actually go a bit further lower. Scana is getting a little bit interesting there. That was considered to be a takeover target. But what happened was a nuclear power plant they were building, the Summer plant, just really too big a project for this company, given the fact that it's the first mover in the United States and there are cost overruns, and the lead contractor, Westinghouse, which had borne a lot of that cost risk, actually filed bankruptcy. So you went from a very high valuation, now you're down to a reasonably low one, and where this company might actually become more attractive as a takeover target. Again, the kind of things you want to explore at conferences like EEI, but at least it's also a testament to the fact that high expectations can certainly be disappointing. There is one other area of risk, and this is what I've produced for you on this next slide, is the current dividend watch list. Actually, a dividend watch list, or what I call the endangered dividends list, from the October issue of Conrad's Utility Investor, and shows basically endangered dividends, how far I think they can cut those dividends, how these companies score on my quality rating system, and what my current advice is for them. So I do this in every issue, and some of these names are not electric utilities. Shows you something of the breadth that we cover in the regular issue. But it does, I consider to be an early warning system. Just looking down the list here, a couple of these names have actually cut in this earnings season. So, and their share prices have suffered. And in any case, good to be out of them. So I take this part of the job very seriously, warning investors about potential dividend cuts and other problems. I don't think a lot of these companies are going to announce dividend cuts at the Edison Electric Institute meetings. But again, it's the things that they don't answer, and the things that they don't address that I think will be pretty good confirmation to me that there's potential trouble on the way.
Great. Well, thank you, Roger. I think we want to kind of circle back now, and everyone who's tuned in, we appreciate you sticking around and staying for the entire presentation. We're going to shift gears now a little bit, but Roger, I want to circle back on the post-conference report that you've been doing for years now, and I want to ask you what you're most focused on, and do you have an idea of where you'll look for an edge this year? And also, can you tell us what Conrad's utility investor readers can expect to see in this year's report?
Yeah, okay. So, this next slide, I think, will probably clear up a little bit of that, what this event is. I mean, it's a place where you get executives from companies to in an environment where they can interact with analysts and investors and so on, and in a variety of environments. One thing that you do is basically suite hopping. So they have these companies will have a hotel suite where they'll hang out, and you'll just come to visit. And I remember last year I was in a room with, I think, about a dozen people from Dominion Energy, and it was like being in a candy store in terms of being able to answer questions. It was kind of at the end of their hosting session, and I was one of the only people in there. So, that's the kind of thing that happens at these events. I'm going to look very, very carefully at what the panels are talking about. And like I said, last year it was, utility and big tech relationship. The year before that, it was a lot about solar and the adaptation of distributed energy technology and also utility scale solar technology. And that was a real eye opener for me. It really told me that utility companies were really getting the leg up on the installers of solar power that everybody had been talking about, and were trading at such high multiples, and that really the way that these companies could go forward, the first solars and so forth could go forward, was to cooperate with utilities, and they weren't really not really disruptors. So that was, again, that was a big takeaway from that conference. And this time they're talking a lot about utility rates, and actually the adjusting of rates to the new grid realities. For example, the use of intermittent sources of energy, much more extensive, like things like solar, that the sun's not always shining, and or the wind's not always blowing. So how are companies going to make that work as they operate overall power grids and so forth? So that's going to be, to me, a very important matter, because if a company is able to get cooperation of its regulators and adjust its business plan accordingly, I think it's going to be a tremendous opportunity. I've mentioned a few of the other things I'm going to be looking at this conference. I'm looking at names that I think are that I have thought were very high priced, and kind of reassessing whether their growth makes them worth the prices that we're paying. I'm going to be looking at some of the companies out there that have made some big moves, and companies that are involved in mergers, kind of looking for signs of fraying. There's a lot of deals out there right now, and there's a lot of risk, because if these deals do come apart, and you own shares of the company that's been targeted, you stand to lose a lot of money. So those types of that type of thing, obviously what the Trump administration is doing and how that is interacting with various state regulations, and how companies are responding to that kind of environment. Those are really big issues. That who's going to win from these nuclear, from this nuclear policy? There's a handful of companies I think could really blast off from here, including one that I've had in the portfolio for a very long time, and has recently bumped well above where my buy target has been, and that's a good thing. I like that. But should it be a buy? Should it be a buy now because of this changing policy particularly on nuclear energy? So again, that's we go here. We try to. Everybody tries to find an edge in this market, and if you're an individual investor, times are a little bit scary in that there's so much passive investing out there. There's so many huge pools of money sloshing around. There's so much new volatility, but there really is an opportunity to pick up an edge if you go the extra mile, and that's pretty much what we're about organization wide. We talk a lot about this in our other publications as well, Energy and Income Advisor. This is, again, the big event for Conrad's Utility Investor, but there are other events that we look at around the year too, and we share all of our findings with our Conrad's Utility Investor readers. So again, that's what I'm looking to do at this conference. I want to answer these. I want to go there. First of all, I'm prepping pretty heavily right now. I'm looking at earnings like crazy, and looking at conference calls, listening to conference calls, and a lot of companies have reported. A lot of companies will be reporting that week, so makes things a little inconvenient. But that's I'm getting prepped. I'm getting my questions together, and I'm getting my schedule together, because it's a lot of running around between various events and so forth at something like this. But I'm very excited to get down there and get started, and then of course producing that report for Conrad's Utility Investor readers at pretty much as soon as I get back. I'm targeting to have it all done by the Friday. The conference runs through Wednesday, so that's give myself a little bit of time. I will try to get it done even faster.
So Roger, I want to interrupt because we've got some questions coming in, and before we jump into that, I think we want to touch on a big thank you that we want to give to everyone who attended tonight for sitting with us. We're just at 1 hour now. And to thank everyone for coming, we have a special discount code for Conrad's Utility Investor. You can see on the screen here with Edison 17. We have a private discount that we're offering for just people that are here on the webinar. So everyone can go to the URL that Roger has highlighted. And it's also in the chat box. And I think, Roger, on the next slide, you might have the URL there, but it's Edison-Prep-2017 after conradsutilityyinvestor.com.
Yeah, I just want to talk real brief, just quickly about the reports. Of course, I've been talking a lot about the last one here on the list, which is Utility Investor Top Takeaways and Best Ideas from EEI 2017. So again, that's what you can expect. The format will be basically you'll get an executive summary, so you'll know what's inside there. That'll have the main takeaways, some brief notes on those, as well as the top picks and the top hands. We'll go right from there. I'll be talking again a lot about the big takeaways. I'll be giving some in-depth information on a wide number of questions that I've been going in there to answer. Pretty much sharing everything that I've got. Then we'll be looking at, of course, the individual recommendations and so on. We do have a few other reports, though, if you're for those who if you're interested in Conrad's Utility Investor. The future is electric, utilities, renewable energy, and electric vehicles. Very much an opportunity piece about some of these larger things that, again, we'll be exploring at EEI. Telecom's a big part of this publication. I've been covering these names for many years, and the names, many of the names have changed, but it's definitely an industry that has a lot, I think, going for it, and particularly probably one of the cheaper areas out there right now as well. How to profit from President Trump's war for coal. I can't take credit for that headline. I have to give that to Peter Stoss, who works with me on CUI and works with us on all our other publications as well. But basically, again, the kinds of things that I was talking about here, I think, how are companies going to line up the priorities of the federal administration with what's going on in the states, and how are they going to turn that to their benefit? And again, some are already doing the job. Some, though, are going to kind of be in the crosshairs of both. So again, another point differentiation. I think again, interesting report. And then, of course, as I mentioned before, my endangered dividends list, I think, is extremely important to follow. So these are all reports, I meant on the last slide, that our Conrad's Utility Investor readers have access to. And I think I have the last slide here, John. I'm just going to leave that up while we answer the questions. But basically, that's the URL that you mentioned there.
Yeah, great. And Roger, this is just such a wealth of information that you've shared tonight. And so we just want to reiterate that this entire presentation, we're going to email this out to folks right after we conclude tonight's webinar, which will also include the Q&A that we're about to start in. So everyone who's still here, we're really excited to see your questions. And why don't we kick it off now, and we'll answer them in the order that they're received. So from Richard, he wanted to first touch on a few different companies that he's been looking at. That, Roger, I think you might be able to point him in the right direction. The first one is Atlantica, and that's ticker ABY. And Richard just wants to know what's up.
Well, this is one that actually I've been recommending for some time. I'm very happy with the most recent development, which is that Algonquin, who I also mentioned earlier in the chat, is buying a 25% stake from the former parent Abengoa, the big Spanish engineering company that's been in bankruptcy. So that's been something that's been hanging over this name for some time. The fact that its former parent still owned a little over 40% of its shares, had some cross defaults on some of its projects. And now that it has Algonquin coming in as its parent, I think we're going to see a resumption of all those promising things we had before. It's a very conservatively run outfit. They basically, their debt on project by project amortizes some years in advance of when contracts expire. So and these are all kind of assets that won't necessarily wear out either. There's a lot of, in fact, a lot of potential in solar panels in particular to replace them with more efficient panels at facilities. So we could see actually some of these, in contrast to the coal plants, which basically when you start seeing various equipment wearing out, corroded and so forth, become extremely expensive to run, you could actually see components replaced at some of Atlantica's facilities that increase production over time, cut costs, and so on. So I think it's a huge deal for them. Again, it's one that I'm really at this point kind of reassess in terms of, do I want to make this a buy again? Because it's back. It had been below our recommended buy price for quite some time, and now it's above that. And definitely based on some of the things I'm going to be talking to the Algonquin people about, some of the questions I'm going to be asking them will have a big impact on how I treat ABY when I come back. And in fact, right after I come back, within days, that we'll be putting up the November issue of Conrad's Utility Investor, which will have all the earnings. We cover more than 200 companies, and we'll have earnings for all but a very small handful that report later in the month of November. So we'll have all that information. We'll have as well as the benefit of this conference. So it's a kind of a big information time for Conrad's Utility Investor readers this next week. This earnings intensive issue with updates on companies like Atlantica, fresh from the EEI, and so forth, as well as the report, which will also be again heavily and very, very intensive on all these names.
So Roger, we have another question from I guess it's Dorian Gray, D. Gray, and he wants to know, or she, what is the outlook on AT&T, and Exelon?
Well, so Exelon will be at this conference, and that will be a name that I'll be taking a very hard look at. They are a potential beneficiary of the new rules on nuclear. This has been a name that we've had for a while. We've had to sit with kind of patiently for a while. It had been depressed for a while, and it had been one of the lower value utilities. And now it's taken off. It's actually well above our buy target. So again, that's the big question with that one. Will be what are we going to and again, it's not the only thing I'll be looking at. I'm looking very heavily at the earnings that they just released and so forth, and for clues there. But this will be a name I'll be very interested in asking some pointed questions of at this EEI. AT&T. Of course, that's a telecom, so they won't be there. It is in our coverage universe, and it's been a portfolio pick for a while. I would characterize it right now as fairly deep value. I think people are really looking at this company in terms of the here and now, and so this cord cutting narrative has really gotten almost deafening when you read various opinions about AT&T. The idea that millennials will pull the plug on AT&T's direct pay television services and so on, and that's based on there's some evidence in that they did lose some customers in the most recent quarter. Some of those were due to the storms that hit various service areas, earthquakes, and they're very big in Mexico. So you got both of them there. And then also some was due to raising credit standards for their customers. So they lost some customers that way. But some of it is from basically this a switch in the business model where you go from these subscription models to a more what you might call an a la carte format. And I think AT&T is very aware of this. I think companies like Comcast are very aware of this. They're moving their business models in that direction. I think there is also some evidence that moving to this type of a model doesn't necessarily mean lower revenue, because people often tend to buy more when they're buying that in that manner. It's just a different way of consuming services. One thing we do know is that the emerging generation is very heavy data centric and uses many devices and downloads lots and lots of things. And AT&T is in prime position to take advantage of that, because they are in very much a pole position in terms of deploying 5G wireless and wireline communication systems over the next couple of years. Why do I say that? Well, because they have pretty much more free cash flow than anybody else, and they spend more on capital spending than anyone else. They spent over 16 billion in the first 9 months of 2017. The nearest rival in their space was Verizon at about 11 billion. What AT&T spent was basically twice what T-Mobile and Sprint spent together. So they've got a big lead. I also put Verizon in that category, but I think that's really where you want to keep your eye on the ball with this one. I know there's been some concern about dividends and so forth. Certainly, in this space with and many telecoms have seen customers shift and so forth, and many have lost customers, have lost revenues. That's never a good situation. I do see a number of telecom companies as being at risk to cutting dividends and eliminating dividends. Go back to that slide in the endangered dividends list, you can see that, but you'll also see that AT&T isn't among them. So again, one that I think is undervalued, and I will have a good bit more analysis on it in the November issue.
So we had another question, and this one is about Nextera Energy Partners, ticker NEP, and also Hannon Armstrong, HASI. Any insights as to where they're going?
Both are, both of those are also CUI companies, and we've done really well with them this year. So I hope the caller is, the questioner is, and
also Roger, why they've kind of dropped NEP specifically over the last couple of days.
Well, that's good. Okay, so we've obviously done pretty well in these things. If you've held them, if you bought them as where we have, I think some of the pullback is I think most of the pullback is just basically that they got a little bit overdone. We've actually been advising people take small profit in when they were at those higher levels, particularly NEP when it was in the low to mid 40s. We were advising because our buy target was at 37. It was well above where we thought worth a buy. So we frequently do that. We try to be opportunistic, give people an opportunity to take a little bit of money off the table. But there's nothing wrong with this company. Dividend growth is a major driver of the yieldcos. Talking about NEP in particular, their most recent increase is at a 15% annual rate. So that's actually the top of their 12 to 15% annualized rate of growth. They have a very strong parent that's very supportive in Nextera Energy. So we're not worried about it. We do think though that occasionally some of these names do get bid up to very high prices. As far as Hannon goes, this is not really a utility, but again, it's one that we cover. It's a business development corporation, or a BDC, that is focused on renewable energy projects. So they loan money to various projects around the country. When a company wants to do a school, for example, wants to do an energy efficiency project, can't really access ordinary sources at good rates, and that's where BDCs come in all across the board. I don't really like BDCs as a rule because typically they tend to be pretty murky. They're kind of basically black boxes in terms of analyzing what they have. This one though I think is much more. There's much more visibility in terms of what they do, and like I say, we got into it pretty far, well below where it is right now. It had been above our buy target for some time. It's been kind of hovering in that area, and there are various potential reasons for that. I think people are worried about the Trump administration perhaps cutting back on energy efficiency projects and certainly or renewable energy projects. But I think people have been worrying for no good reason. In fact, if you look at the tax reform package that came out basically today, there's still provisions in there that support these various industries. And the reason is simply that these industries, they're not where they were in 1981 when the federal government changed policy dramatically and basically ran the whole renewable energy industry out of business. I mean, they're competing on these projects compete on economic terms. You know, Hannon actually very impressively, a couple has issued what are called green bonds, and green bonds, they're basically borrowing money for various projects, but because there's such a demand, particularly from various huge sovereign wealth funds in Europe and so forth, tremendous demand for these green bonds, and they just basically are called green bonds because they finance things like renewable energy or energy efficiency. And because they're in such high demand, the cost of capital is extremely low. So here you have Hannon, which is a BDC that's issuing capital, long-term capital, at long-term bonds at rates that are comparable to what even what a utility might issue them. So it's fairly extraordinary. You have to have your hat off to management, but you do want to be careful in terms of what you pay for something like this, because again, as the questioner pointed out, I mean, you get up to certain levels, and again, this is a broader point I've made in this presentation. High price levels lend themselves to disappointment, and that's you can take the attitude, well, I'm just going to hold on through the ups and downs, but if you're willing to do a little bit of juking around a little bit, I would call it, take a little bit of money off the table at times, and this is what we've been doing over the past year or so. These names have gotten really expensive at times, and sometimes they've been really cheap. So that's a really good way to juice your returns, and I think there'll be more opportunity to do that going forward.
So Roger, another question from some of our readers here. SEDG, Solar Edge Technologies. We had a question about that, solar equipment provider, and then also CenterPoint. Do you imagine that there's going to be a takeover or even potentially a merger happening? And that's a question from Charles. So thank you, Charles, for the question.
Well, I think CenterPoint is actively shopping itself. How it succeeds in doing that, I think, probably depends on if they're successful in unloading the unit, or their half general partner interest and full 41% plus limited partner interest in Enable Midstream, which is an MLP, and which has been up and down. It's doing pretty well right now, but they've made no bones about their desire to sell it. I'm looking for some more news on that, possibly as soon as tomorrow when they announce their earnings. So that's something I'll be looking at very closely. But if they are able to do that, I think there's a lot to recommend them as a potential takeover. And the same can be said for any number of names. And I think you do want to be careful if anyone looking to buy a name like CenterPoint, because it has gone up a lot recently, for that precise reason. They are very much on a target list for takeovers, and particularly if they did get rid of the midstream side. The midstream side isn't necessarily bad, and in fact, I really like Enable. And those of you who are Energy and Income Advisor subscribers know that we have that in the portfolio. We talk about it a lot. And even though they didn't increase their dividend this quarter, they are definitely on the right track. But CenterPoint with that is, I think, a little bit riskier of a proposition for a would-be buyer. But again, I do think there'll be a takeover of CenterPoint at some point if they are successful unloading the stake in Enable. Regarding Solar Edge, and I'll just make a general comment about solar companies in particular, solar components makers. I think they, obviously we've seen a lot of ups and downs here with this tariffs situation that we talked about a little earlier in the presentation. The two companies, Solar World AG and Suniva. Suniva is a subsidiary of a Chinese conglomerate. Solar World's a subsidiary of a German conglomerate, but they are the protagonists, I guess, in this case before the International Trade Commission, which they came and made with the claim that and convinced the ITC that they've been harmed by solar panel imports. So that's definitely sent a shockwave across the industry. I think a lot of people looked at this case and said, "There's no way this thing's going to fly." And frankly, I don't think it would have under, say a George W. Bush administration or a Clinton administration or a Obama administration or any the previous administrations. But right now, the administration has made trade a very big focus, and protectionist policies that have really been, I'd say scorned historically, or being pursued. So it's not a big surprise that we would see these tariffs, but it has sent shockwaves through the industry. And I think there are some serious questions in terms of what is going to happen to solar demand. Now, the recommendation that the ITC is making is for a 35% increase. It sounds like a lot, but the plaintiffs here were asking for basically a 100% tariff. So it's well below what they were asking for, and that's given some relief for some of these solar companies in the near term. But keep in mind that the president does make the final decision. So if the president wants to send a signal, or which I think eventually, if there are 100% tariffs, you're just going to see a lot of relocation of manufacturing of these panels to the U.S. because it is a huge market. But if you do see that, I think you're going to have a shock for about a year. And I think what you'll see is companies that are the adopters of solar will be using the stockpiles they have, and will, in the case that of utilities where they do have the option of meeting renewable energy targets with other sources like wind, they'll just turn to those other sources, or they'll turn to grid investing, or they'll turn to natural gas for their investment dollars. I don't think anybody's going to pay, double what solar panels are now, and at least unless they're, absolutely, there's no alternative. So, I think that, again, we're just going to have to see what happens with this tariff case, but it could be really damaging to any company that doesn't make its stuff, mostly at least in the U.S. SolarEdge, I think, is not as badly positioned as most. First Solar obviously was excluded from the plaintiff's initial complaint because it's a different manufacturing. It's not crystalline silicate, so that was specifically targeted in the suit. But there I think could definitely be heard as well if there's a movement away from solar adoption. I think that the main takeaway from this whole thing is that if you're going to play solar, the adopters are a much more sure way of doing it, much lower risk way of doing that. And when I say adopters, I mean companies like the utilities that are buying solar plants, or the yieldcos that are putting them up. In fact, there's a case to be made that the existing capacity of these solar plants will be, what's already been built will be more valuable if there is a lull in construction due to skyrocketing panel costs. So we'll see what happens. That's a long-winded answer, but I think for the most part, this is a group that it's probably best avoided by most people, and unless you're a very nimble trader. And again, if you're a long-term investor and you're trying to take advantage of solar adoption, I think these yieldcos are very attractive plays, and we write a lot about them in Conrad's Utility Investor. They're going to be a big part of what's going on at EEI as well. Or you take a look at the utilities themselves, which are the major investors in solar. Utility scale solar is, the costs continue to decline, and that's what's going up right now. And costs are actually far. I have this debate with some readers, but depending on what you read, and you might have a different opinion, but utility scale solar is competitive, straight up with many other sources at this time too. So putting tariffs on panels could change that, but I think longer term, it's definitely a place companies want to go, because you eliminate a lot of potential environmental liability. You don't have to buy fuel That's the big, concern a lot of companies have with gas. It's cheap right now, but what happens at some point when gas does get more expensive? And usually that happens when people get very complacent about the cost of gas. So I'm not predicting a big spike in the price of gas. In fact, I think we're going to see a lot more adoption. But building solar is a very attractive option to utilities. EEI is going to be very interesting to see if it's more attractive than people were talking a year ago or 2 years ago, or maybe there's some additional concerns that need to be addressed.
So Roger, we actually have one participant who wanted to ask Elliot a question. So you can answer it now, or you can wait for one of our other MLP focused webinars. I'll leave it to you. But the question was, do you see any MLPs utilizing any wind or solar in their operations?
That's a good question. I think that what you're mainly seeing, that the vehicle that's mainly being adopted for that use is the YieldCo. So they're kind of, they're not exactly MLPs. They do have MLP structure and benefits as far as the parent goes. So NextEra Energy Partners owns pipelines, but the main business is contracted wind and solar power plants that that have been dropped down from the parent NextEra Energy. So NextEra Energy has control of NextEra Energy Partners. They get the lion's share of the cash flow from that entity, even though they have incentive distribution rights. That's another similarity with MLPs, which they have actually walked down. That was a very favorable development for NEP. But it's, they get the benefit of owning, being a general partner. Now, shareholders, as far as they're concerned, the YieldCo dividends are not K1s. They're not partnership dividends. They're just ordinary qualified dividends. So, a lot of people like that because they don't file K1s. You don't get the return of capital tax advantage generally, although some of them have paid a portion of dividends as return of capital due to various developments. But in general, that's the setup there. And so that's how contract renewable energy, which is very similar to some of the midstream assets in that it's long-term contracted and revenues therefore tend to be very, very steady, and coming out of them. So they're pretty ideal to drop down to some entity paying a big yield. But that's what we're seeing. Now there are some interesting MLP-able assets that aren't yet, that as far as I know have been MLP'd, and that's a good reason to go to the MLPA conference. We've actually been to that one a good many more years than we've been to EEI, and that's given us a lot of, I think, a pretty good edge as far as the MLP space goes. Trends, danger spots, MLPs no one's really looked at. We go to that one as Energy and Income Advisor, and it's certainly very, very helpful every year. That's in June, and the report is for subscribers of that publication. But I suspect we're going to see some MLPs that are specializing more in water, and particularly water recycling, those types of issues. But renewable energy, I'm not entirely sure what we're going to, how that's going to work. Someone mentioned Hannon. We answered a question about that. And that one, it's a BDC, but it's kind of similar to that kind of a format, because most of their, they realize some tax advantages by their structure. They have studied going to a YieldCo format. Right now, they're realizing the advantages of being a real estate investment trust. So on that, or at least having those similar organizational structure. But, that example could be a precursor to something. But I think that, the bottom line is that these are assets that are they're very similar to what is inside of MLPs, in that they generate pretty steady income. And in fact, the length of contracts you see on Atlantica, which we talked about earlier, 20, 25, 30 years on average. That's much longer than the average pipeline contract, certainly much longer than the average G&P contract. So an interesting area. And I think, these are, it is a business where it generates a lot of cash, but there's a lot of pressure to recycle capital. So, I think we will see more deals like, for example, Southern Company's deal announced this month, where it announced it's going to sell a piece of its solar power portfolio. It's a profitable portfolio. It generates a lot of cash, but by selling a piece of it, Southern gains more capital. It can use that capital to invest more in more facilities, increase its overall cash flow. It can use it to reduce debt, wide range of various uses for things like that. But that's a really good question, and it's definitely it's definitely something that we look at most closely in terms of what we might see popping up down the pike.
Well, Roger, that was incredible answers to all those questions, and everyone has been just responding here for the last 15 to 20 minutes. We have one more question that we'll take right now, and then I think we'll want to wrap it up.
Okay.
So this is from Robert, and he says, in research and utilities, they're building huge batteries to store wind and solar energy for distribution. In point, lithium is a main component of such batteries. Will you or Elliot ever start covering the best companies that are in position to provide battery storage? I hope you understand the question.
Yeah, I do. And this is definitely an area that I think is very, very interesting regarding utilities. And it's just to talk about utilities for a second. There are a number of companies, and also at EEI, AES Corporation being one, that are on the other side of that transaction. So they're building storage facilities and on a global scale. In the case of AES, they're allied with a company called Siemens, a rather large German engineering firm, and their alliance is going to be pretty much global. And again, energy storage is going to become more integral to utility systems because of growing use of intermittent sources like solar and like wind. It's going to be more important to harvest energy, store it, and then release it when needed. And the old duck belly has not been repealed, and in fact, it's a more urgent question, I think, in many areas than ever. And basically, what that means is the duck belly is a graph of power prices. The popular duck belly, it's a graph of power prices at the California Independent System Operator on a daily basis. So you start out at the tail of the duck, and that's kind of a middling demand. And then during the day, as more solar power comes on stream, demand for grid generating electricity drops. And so the belly has been dropping ever lower in the middle of the day as more solar energy, more distributable energy has come on the California grid. And the problem with that is that as that demand falls in the middle of the day, it becomes less economic to keep power plants running for that big upsurge in power, which is the head of the duck and the duck bill at the end of the day. So a big spike up in prices. So that's definitely on a lot of people's minds. And I think that's why we're going to see many, many more, much more investment in energy storage. Now, is it going to be a lithium battery that's doing the job, or is it going to be something else? The biggest source of energy storage right now, and this often surprises people, is actually pump storage, what's called pump storage. And this is probably one of the most inefficient on an overall basis processes, but it makes perfect economic sense. Basically, what happens is at night, a baseload power plant for example, a gas burning plant or a coal plant or a nuclear plant will pump a very large volume of water up a hill. And then, which requires a tremendous amount of energy, of course, right? But in the middle of the night, no one's using it on the rest of the grid, so it's just generating it. And, again, pumping that water up the hill. Then in the middle of the day, when all that demand comes on, that water is released. Or you could release it, at the end of the day, when everybody's getting home, the sun's gone down, everybody's TVs and computers are turned on, that bill of the head of the duct there. And that's the biggest source by far of energy storage capacity. Where battery storage has been deployed in many areas. AES has several big projects in California. So does a company called AltaGas that we cover. And these are very profitable. They're just basically operated on contract like they would any other source of power. And again, as more renewables, as more distributed energy, where, for example, just rooftop solar panels on people's homes, as more of that energy enters the grid, it's going to be more important to store it. There's a tremendous cost savings opportunity potentially when you have something like that. In fact, you can replace the need to build a new power plant. I'm really looking forward to what they're going to say at EEI on this issue, because I think, again, utilities are going to drive it. They're the companies that have the dollars to and the need and the economic incentive and regulatory support to make this happen. We are seeing also a big ramping up of battery production in China. The main reason solar panel costs have really dropped going forward and efficiencies improved so much is because under the previous 5-year plan, China really made a huge commitment to just pouring a lot of resources into producing solar panels. So, the U.S. put tariffs on in various places, but the end effect was that a lot of manufacturing went on and a lot of efficiencies were made, and we kind of reached a tipping point with solar, like we showed in that slide earlier in the presentation. I think the same thing could definitely happen with batteries, and again, the price of these things could come down. Again, will they be using lithium? I think the big problem that Elliot and I have had with recommending some of the lithium plays out there is just that there's so much hype around them, and we've had some experience in the mining business as well. We've been around a pretty long time. In fact, one of the first industries I ever looked at and one of the first stocks I ever bought was a mining company. And there's just there are a lot of ins and outs with these things, and it comes down to as an investor, when do you in? And when are you out? It's more than that. It's been more than that particularly with the smaller names than it is with can a company raise the cash for its mine. In fact, it's kind of divorced from that. Companies really need to get their stock prices up so they can raise the capital to build a mine and get production to market. While they're doing that, of course, prices of commodities are all over the board. But if they can do that, then they can get their mine running at least. Maybe they can hedge. Maybe they can become a long-term player. On the other hand, as you're an investor, that's probably the last time, the worst time to buy, because the prices are already up. So, we are looking at it, and I wouldn't rule out us, coming up with a name at some point. Certainly, we've recommended a number of commodity names in the past. This is a tough time for a lot of commodities. It's been a tough time for oil, for one. We think that oil has hit the bottom and is probably will be on the upside at least for the near future, and that oil stocks have finally gotten, and oil companies have finally gotten, at least the good ones have finally gotten adapted to a range of oil prices that's well under $100 a barrel, which again we just had that like 3 or 4 years ago. But again, it's it's the kind of thing that we are probably more likely to recommend as a trade rather than anything long term.
Oh, Roger, you're talking about oil with that Elliott. I'm sure he's going to miss that opportunity.
Well, we'll have plenty of opportunity to hash that out. But
So, so I want to first, Roger, I want to thank you for tonight's presentation. We'll give you a big round of applause here at the CT family.
well, thanks everybody for tuning in, and those of you who are viewing this later, really appreciate you listening. We hope you'll take a look at CUI and this report that will be coming out in about a week.
Yeah, and Roger, how are you going to be delivering that report, and how can people get access to that and make sure that they're ready to go on November 9th, right when you get back from the Edison Electric Institute event?
Well, to become a Conrad utility investor reader, this last slide here has a number of avenues to follow. Like we said, we're offering a fairly substantial discount on the product, which includes 12 monthly issues, frequent what I call roundups, kind of, which are updates of companies and strategies in between time. We have alerts when merited. We also have a thing called Income Insights, which is periodically comes out, just pretty much an idea.
So Roger, how big is the Edison 17 discount?
The Edison 17 discount, it's $100 off the regular price of $499. So about a fifth off, I think. But 20, a little more than 20%.
Guy, so I'll trust you on that.
Something like that. I'm saying that without a calculator. But we have just a few more things. We have quarterly chats, and of course I like to field people's emails as well. So. We think, and we do have these periodic reports. We go to EEI as well as some of the big conferences. And I'm very excited about this one. I hope all of you will consider and come and take a look at it.
Great, awesome. Thank you, Roger, and thank you everyone for sticking around tonight for almost an hour and 42 minutes. We'll see you next time, and we'll be in touch. We're going to end the presentation now.